it's a numbers game, right? And if you treat it that way, this business actually gets really easy. Real Estate Lab. What's up, guys? Now that we've got our REL account set up from our last video, I'm going to go through and walk you guys through the entire underwriting process. We got a sample deal here. It's a 20-unit property in Michigan, and we're going to go ahead and just figure out, start to finish, what price would make sense for us to offer on this property, what price would make sense for us to buy it, and what would our returns look like, and how does the underwriting process all work? And the interesting thing about this is it's something that you're not going to pick up just after one video and perfect, right? You might get the process down, but when you really get good at this is when you practice it. And you've got to actually run deals through the underwriting model, through the software. You've got to look at a lot of projects, a lot of properties. You've got to start forming correlations between the projects. It's a numbers game, right? And if you treat it that way, this business actually gets really easy. So as I've stressed, this is one of the most important parts of the business. I want you guys to get really good at it, but it takes practice. So if you want to become very powerful in this business, I heavily suggest spending a lot of time underwriting deals, getting good at it, and at least understanding how it works, right? Maybe if you're not the one on your team that's doing this, somebody else is, you still need to know how the numbers work, and you still need to run through a couple deals to see how this all fits together. So without further ado, let's hop in. We have a 20-unit property today. It's called Royal Oakland. So if you guys can see my screen here, we're going to go over to the software after you've logged in, and I've got a demo account pulled up here, and I'm going to go ahead and add a property. So the name of this property is Royal Oakland. It is at 314 Oakland Avenue in Royal Oak, Michigan. It's on Oakland Ave in Royal Oak, so it's named Royal Oakland, which is cool. This is built in 1980, I believe. An asking price, let's say it's $4 million. Offer due date, let's go ahead and set that to next Friday. And contact, we're going to go ahead, create. Okay, so next, what happens here in the system is we're going to add a new property. It's going to pick a thumbnail for us. This is just a thumbnail photo. So API pulls a street or a satellite view. So I'm going to pick that street view there. And we can upload documents here. We're going to skip that, and we're going to do it on the actual deal page, property page. So once we get to this property page, what I've told you guys is when you're underwriting a deal, there's two things that you need, a rent roll and a T12. Optional, but if it's listed on market, you're going to get what's called an offering memorandum or an OM on the property, and the OM gives a lot more details. We don't have one here. We just have a rent roll and a T12. So when you're going in and talking to a seller, a T12, as we said, can be called multiple things, like, hey, I need a profit and loss or an income statement or a 12-month income statement or cash flow statement, but we call it a T12 in the industry. So you get a T12 and a rent roll. Rent roll, obviously, as we discussed, shows all the units of the property. So let's go ahead and really quick and take a look at our T12 and rent roll here. So first, I'll show you the rent roll. And we've blocked out the tenants' names for privacy purposes here. But here is the rent roll. So we've got the unit number. There are, I'm going to count them. We've got 20 of them. We've got 3 vacants. So we've got 17 out of 20, which is 85% occupancy. We've got the 1 bedrooms are 750 square feet, and the 2 bedrooms are 950 square feet. So we can go through and count all this stuff, right? Here's our market and effective rents. We can go through and count all this, but the cool thing about the software is if you have a rent roll in Excel, you actually can just go in here and upload it. So let's do that. But typically, when we get into the analyzer, which I'll show you in a minute, you would have to go in and input these things, right? So I'll open up the analyzer, just show you really quick. A little disclaimer here, but let's go to the unit mix and rents tab. I don't believe I've walked you guys through this in depth yet, but here is the unit mix and rents tab. We've got a row for each unit type that we want to input into here. So let's say you have 10 unit types, right? You're going to write all 10 of them out, square footage, the number of units for each. So what's cool about the software, though, is we're going to save some time. Instead of having to go through and count all these out, we're actually just going to upload it. So I'm going to exit out of this really quick. We're going to go to the unit mix section, rent roll section, and we're going to parse a file here. So I'm going to go ahead and select, I've saved it here for speed purposes. I'm just going to drag and drop, and we're going to click the parse button. So what's cool about this, Seth, if you don't mind blurring out this column right here, we're going to go ahead and we are going to just look at these units real quick, make sure we categorize them properly. I know, I've been told there's some renovated units at the property right now. I want to designate those units as renovated, so I know the difference between the renovated rents and non-renovated. And then we're going to make sure all these columns are lined up properly. The software auto detects the columns to the best of its ability. If it doesn't, you can actually manually switch. So this is status, yes or no. I'm assuming that's vacant or occupied. So that's set to occupied. Market rent properly set there, and effective rent properly set there. Really, the most important things are the effective rent, the square footage, and the floor plan. So we can get the unit type. What's the square footage? Obviously, we want to look at bedrooms and baths, but for software purposes, the final thing we want is the effective rent. So we could actually get an average of what's the effective rent. And I'm sure you guys can see, having to go through this rent roll, having to go through a rent roll when we've got, 75, 100, 200 units, it starts to get intensive. 20 units, it's not bad, right? But it starts to get intensive. So what I want to do here really quick is I'm going to go and find, I know there's a couple units. We've got this one, 103. This is actually a renovated 2-bedroom. So I'm going to do create floor plan. This is 2-bed renovated. The Roy A is actually 1-bedroom. Roy C are 2 bedrooms. So there's a couple 1-bedrooms. Here's a 1-bed that's actually renovated as well. You can see from the higher rents, $1,300, $1,300, and $1,400. I know those 3 are also renovated. So I'm going to go and create floor plan. And we're doing this for a reason I'll show you guys in a bit. 1-bed renovated. The reason we're doing this is we're going to go continue. And now you can see this is a 1-bed unit. This is a 2-bed unit. And then we've got these 2 are renovated. And the reason we're doing this is I want to see, now you can see for the 1-beds that are non-renovated, I can see what the actual effective rent is. And for the 2-beds that are not renovated, I can see what the effective rent is. So they have obviously really low rents right here. And then this is the 2-bed renovated and the 1-bed renovated. We can see what all those rents are. So I'm going to go ahead and confirm. It's going to pull that data in here for us. Average of 1,057, average effective $1.35. So we're going to go ahead here. Next is the T12. So I'm going to go and show you the T12. T12 is a 12-month trailing 12, as I've told you guys. It's a 12-month profit and loss statement. So we're going to have our income up in the top section here. And this totals up. Gross potential totals here. Rent adjustments totals here. Other income totals here. And, those 3 will add up. This one, and this one will add up to total this. So if this is your first time looking at a financial statement, just getting the flow, like, hey, these 2 total into this. These 3 total into this. These ones total into this, and 1, 2, and 3 total into this 19,707. That's kind of how it flows. So same thing going down. Now we've got our operating expenses, a whole separate category: payroll, management fees, general maintenance, leasing, contract services, repair and maintenance, unit turns, utilities, taxes, insurance. All that totals total operating expenses, and then we've got our net operating income. So a couple things I'm looking at here. I want to see, is the income trending up, down, left, right, staying the same? In this case, you can see it's trending up. I'm assuming that's because they're renovating units at the property. As we see, they've got a couple renovated units. They're bumping rents, which is all great. So that's why rent has been trending up. In addition, I'm going to look at the expenses and see what the expenses are looking like. They're pretty standard across the board. We're averaging $11,000. It doesn't seem like they're going up or down too much. There's some down months. There's some ups. And then net operating income is increasing over time. If we just take the average of the last like 5 months, 13,000. The average of the first 7 months is about just a little under that. So we've got some highs, some lows. It doesn't seem to be trending too far up. I think the income is more than the net operating income. Maybe there's some poor expense control there, and that can be done a little bit better. And with the trending, upward trending income, we can get that NOI to start trending upward more as well. So normally we'll spend a lot of time going through this, and we're going to pull the data from here, just like the rent roll and the unit mix. I'm going to have to manually go through the rent roll, pull it over into the analyzer so that I could start typing in what my projected rents are. Same with the T12. I normally will go through in every category I'm going to go through. I'm going to take this number and I'm going to go put it into the analyzer. And that allows me to now look at a side-by-side. I'll show you in a minute. Cool thing about the software, again, if you have it in Excel like we do now, we're going to go ahead and just parse this thing. I'm going to go down here. We're going to grab a T12, throw it in here. We're going to parse. And then we're going to make sure everything's categorized correctly. So right off the bat, I see the software does its best to categorize things. If it doesn't, you can move it around. So gross potential rent has not been properly categorized. So I'm going to go find that. Oh, market rent. This is the one that we want in that top column. We're basically trying to get it to match the T12, these totals, gross operating income, 294,227. 294,227. So as long as that matches, we're in pretty good shape. And then same thing with the expenses. We do our best to auto categorize. It doesn't always categorize them perfectly, but it does its best to put them in these standardized categories that match up to the analyzer, right? So a lot of times the T12 has different categories that maybe aren't in the analyzer, different subcategories like this that aren't in the analyzer. So we have our standard set in the software that allows us to transfer those over. So this all looks good right now. We're going to go ahead and confirm. It's going to pull some data down here. You can see our gross income, expenses, 46%, and we've got net operating income of 160. So once that's done, obviously if I wasn't walking you guys through that and talking to you guys about it and explaining the process, it'd probably be a really quick process, maybe 2 or 3 minutes to go ahead and do all that. But now what we're going to do is we're going to go and open up the analyzer. I'm going to walk you guys step by step through how we analyze a deal. So this is an analyzer I built. I've been using it for about 6 years now. It's evolved constantly. Every time I find something that could work better, I improve it. I try to make it better. And so always trying to improve it, make it better, and expand functionality, make it easier to use. And now it's obviously integrated into the software. So the first thing you'll notice, and at all these tabs, we've got 1, 2, 3, 4, 5, 6, 7, 8 tabs here. That's the last one. So 8 tabs. I just try and go left to right. Not all these tabs need inputs. This one doesn't need any inputs. This one doesn't need any inputs. And this one doesn't need any inputs. So there's really only 4 tabs that need some inputs. You only input into the blue cells. So if it's not a blue cell, unless you know what you're doing in Excel, don't touch it. I would say just only touch the blue cells and you'll be good. You really don't need to do anything else. Unless you have more of a custom deal, you need to play around with the expenses or something, you can edit it. But it's not necessary. You can analyze most deals without having to touch anything but a blue cell. So I'm going to walk you through. First things first, unit mix. We're working left to right, unit mix and rents. We're going to go through and we're going to see, obviously we've got 4 unit types. We've got 1 beds and 2 beds, which are the same sizes, but we've got a couple 1 beds that are already renovated and a couple 2 beds that are already renovated. And this is important because we want to make sure when we're going to go through and create our plan going forward, we might want to renovate units. I don't want to renovate what's already renovated, right? I want to renovate what the remaining units that are not already renovated. And so that's why I kind of delineated those or separated those out. But we're going to go through and we're going to put in what we think our rent projections are. And we could start with a baseline, obviously, right? We see that the 1-bed renovated rates are about $13.33. So I can go ahead and put in $13.33 obviously for these because that's what they're already hitting. But the 1 beds that are not renovated yet, I'm going to go ahead and put the same thing, $13.33. And we're going to go and confirm these and look at rent comps, obviously. But this is just a start, a baseline. The 2 beds that are not renovated, they should be getting around $1,600 per the current rent comp. So I'm going to go ahead and put $1,600 because renovated, that's what they should be getting. And then the same thing, this is our column for renovated rents going forward, projected. And then the same thing, the 2-bed that's already renovated, $1,600, right? So our goal by the end of this, what my normal business plan is to go in and renovate and bump rents. We want to get all these units, all 20 of these units at these updated rates, or these might change after we go look at some comps. But we want to get all of our units at the increased rental rates. So, and then let me explain really quick what classic means. Classic is basically saying, if I don't renovate a unit, what are the rents going to be? So I'll go ahead and put that in as well, because it starts off with all units as classic, and then we get to move units over to the renovated section on this renovations tab over here, which I'll show you in a bit. So because these units are already renovated, if we don't renovate them, right, if they stay quote unquote classic, we're going to be getting $1,333 because these are already renovated. These ones currently $934, this one currently $1,050, and this one currently $1,600 because it's already renovated. So this is what we're looking at, and we'll look at the pro forma here really quick. This is what we're looking at in potential income. Let me check the rent roll real quick. We seem a little off there. What are we at here? Effective rent. Okay. So we're going to go back and look at our T12. I want to make sure we're on track. Okay, so the reason why this is higher is because the T12 market rent, this is our, obviously, as I've mentioned to you guys looking through T12, this is our potential rent. So they're looking at every unit, if it's renovated, what is that potential top end if all units were at this market rent. So I'm going to go ahead and do the same thing here. Oops. We're going to reopen this. $350,000. There is our potential rent, as you guys can see. Obviously, I'm going to zoom out here a little bit. We're getting a little Excel issues here. So this is our potential if every unit was at the full market rent, if that makes sense to you guys. So this is our current potential if everything's at the effective rents. This is what they're saying the market rents are, $1,400 and $1,700, right? Which we could actually go ahead and put that into the analyzer as well. They're saying, hey, this is $1,400 and $1,700. They actually got one bedroom at $1,400. They don't have a 2-bedroom at $1,700 yet. That's only at $1,600. So we can use, it's one strategy to go in and look at what units the property currently has kind of topped out on rent. If we want to be conservative, normally you go a little below that, but we could go in and say, hey, they have a unit at $1,400. So we could go in and we can get $1,400 for these 1-beds when we renovate them. And the 2-beds, if they had one at $1,700, it shows that they've proved $1,700 is legit, and we could go through and put $1,700 in there, but we'll leave it for now at $1,600. But we're going to look at comps, and we're going to adjust these even further, obviously based on what you guys were seeing there. So for now, our potential rental income is showing lower because it's using the classic rents. Once we decide to renovate the units, which, my plan on this property is going to be to go and renovate all the units and bump rents, because we can see there's a huge disparity on rents. There's some $400 to $500 rent bumps that are possible at this property. So I'll go and set that right now and show you guys kind of how that works. On the renovations tab here, let me zoom in just a little bit. We'll zoom in a little bit. And so on this renovations tab, there's a unit renovation section. And on this page, you are going to be able to input how many of each unit type you want to renovate. And so these units are already renovated, so we don't need to renovate them. These ones are unrenovated, so we want to go in and renovate these. So what I'm going to do is I'm going to type in 13. We want to update 13 of the available 13 units. And then of these 2 beds that are unrenovated, I want to renovate 3 of those. I'm going to also type in that these are going to be renovated and this is renovated just to show it, but I'm not going to put in any cost because this and this is already renovated. The only things that are going to carry a cost are these. And we haven't put that cost in yet. When I get to the renovations page, after I show you some of the rent comps, we're going to go in and we're going to put some numbers in here, right? So this is going to be a TBD cell, and this is also going to be TBD. So I'll leave that for now. Okay, so let's look at some rent comps. We're going to finish up this page because once we get this page done, we can kind of set it and forget it. I want to go look at some rent comps. So let's first look at, I'm going to duplicate this tab. Let's first go and look at this property of interest here. 314 Oakland. Okay, so here we go. Royal Oakland Apartments. We can see there's 1 and 2 bedrooms, 700 to 900 square feet. And they actually have some pictures here of the renovated units, which is really nice. So we're going to go, I want to look through some of these. This is cool. We've got, I don't know if you can scroll through here. Looks like you can't, but we can scroll through this way. So it looks like we've got a nice updated unit, new cabinets, countertops, stainless appliances. Looks like brand new flooring. Let's look at this one. So we got some nice countertops, nice new fixtures. Big windows, I like that. So we're trying to get a feel. This shows obviously what the renovated unit looks like. I'm assuming the non-renovated unit is a lot less updated than this because they're asking right now $1,475 for a 1-bed, and they don't have any 2 beds available. But $1,475, I'm assuming probably closer to like $1,800 or $1,900 now for a 2-bed. So their 1-beds are actually bumping these rents up a lot more now. We've got hardwood floors, new vanities. This is nice. We've got a new surround, all new fixtures. Kind of weird little knob there. We've got new doors. Looks like nice new doors, right? If this is a 70s, 80s property, it's probably a little, oh, that's cool. Little closet space in the front. This is the exterior of the property, so it's just pretty clean, typical Michigan brick style building. What's cool about this property is it's in a really nice location. These are all, $400,000, $500,000, $600,000, $700,000, $800,000 here. Here's downtown Main Street of this city called Royal Oak. Really nice growing town. It's an A area, high-end area, higher income. And so we're like right downtown. This is it, and this is the Main Street. There's a lot of stuff, bars, restaurants, offices. A lot of people like living in this area because it's very walkable. So we're in an A location on this property. A locations, when you buy an older property like this, a lot of times it gives us the ability to bump the rents more and play around with what we're going to do and higher end renovations and stuff like that. If you're out in the middle of nowhere, you can't over renovate a property. You could do this level of renovation, but you might not be able to bump rents, $100, $200. For this level of renovation, we're probably going to have to put in, $25,000 of work to do, a nice high-end renovation like this. So normally we're going to have pictures. I don't have pictures right now of what they look like existing, but if I assume they're typical C-class type units to be conservative, right, they're probably not going to have like this trim already. They're probably not going to have this. They're not going to have the cabinets, stainless steel, the fixtures. Those are all new, renovated from what I'm being told on this property from the sellers. So we're going to have to do everything. The doors, hinges, handles, flooring, everything. So let's go look at some comps. And if you guys remember, our 1-bedrooms are 750 square feet, and there's 13 of them. They're currently getting, on average, $934 for unrenovated, and renovated, they're getting $1,300 to $1,400, and they're asking $1,475 now. So we want to see if $1,475 is legit because not all these things are set in stone. They might be asking $1,475, but they may be only getting $1,400 as a max, which is what we saw. They might be able to get $1,550. We really don't know. We've got to look at some comps for these 1-bedrooms to see what's actually the case. And we do this on every property. We look at the comps. We confirm, are they high? Are they low? Are they on par? And what is our all these factors kind of play into what's our strategy going to look like for the property itself. What's our plan? So let's go in and just look at some properties here. So I think our subject property is over here on Oakland Ave, Royal Oakland. So that's it right there. So we're going to look at some nearby properties and just see what they're charging. So let's look at this one first. Metropolitan Lafayette. When we look at comps, we want to make sure it's a similar style property, similar age, similar type of amenities. You don't want to comp a C-class 70s, 20-unit property to a brand new Class A. Like, I'll show you really quick. We don't want to comp our property to let's look at this. Icon on Main. This one looks pretty absurd. Yeah, they've got a gym. You know, you could tell it's brand new build. This is a new build property. So, you know, our kitchen styles look kind of similar, but this building probably has more amenities. They probably have a parking garage or indoor parking. In-unit laundry is a big one. On our property, we have an under-the-counter laundry, but it's just not the same. There's some common area laundry in the basement at this property that's shared as well, our 20-unit. But this one, they have in-unit laundry, it looks like. This is the building, so it's a brand new, very nice Class A building. So let's see if we've got one bedrooms. Do they have small one bedrooms? Their one bedrooms are 2,200, furnished 3,800, but 2,200 here for unfurnished. Studio 3,402. So ours would be comparable to their studio. Furnished 3,400, unfurnished 2,000. So right there, that tells me like, hey, our one bedrooms are pretty darn nice compared to these, right? These are really nice. There's a Class A. Ours are like B or A minus in this condition, right? This is a nice unit still. Not as nice of a property overall, but if they're charging $2,000, I feel pretty comfortable we can get that $1,475 that they're asking for based on what I'm seeing, right? So let's go back, but let's go find some units that are maybe more similar. Center Street. So this one is right. Where is this one located? Center Street Place. So it's right down here. We're going to click on that, and we're going to see what type of units they have. Their studio, 370 square feet for $1,150. One bedroom. Their one bedroom is 400 square feet, and they're charging $1,350. And this is what it looks like. That is not nice at all. Wow. That is dated. Yeah, I don't, similar type of building, but this is not even close. Wow. So they're charging $1,350. It's almost half the size. So now that the $1,475 that these guys are asking for is starting to look low based on what we're seeing. We have another one that's $750 and a new build that's charging $2,000. We have a crappy old unrenovated one bedroom here, almost half the size, and they're charging $1,350. So to me, when I'm going to start, let's look at one more comp. You know, it's confirm it. I like looking at 3 or 4 normally. The Aldor is right over here. Let's look at this. The Aldor. $1,250 for a 370 square foot studio. $506, $1,295. All right, this is crazy. We're at 750 square foot, and we're much nicer than both of these properties. Our renovation level, much nicer. Our rents need to be probably at $1,475 to $1,500 makes sense. So let's go in and for our, because with what they've already renovated, we're going to be able to, without doing any work, we should be able to bump these on the next time they turn around to $1,500. And our one bedrooms that we're going to pay to renovate, the 13 that are unrenovated, we should be getting $1,500 as well. So that's where those are at. The two bedrooms. Let's look at some more comps. They don't have any available right now, but let's go ahead and look at some 2-bedroom comps. Do they have any here? No. Let's go and look at 2 beds. See if we got some 2-bed comps. So I always like looking at a higher end brand new build as kind of like a top line. Like, hey, we're probably not going to get this, but they don't even have them. 2-bed, 1,150 square feet. So they're bigger. Ours are 950. They're charging $2,500 to $2,900. So we most likely won't get up to $2,500. But let's keep looking. Let's go look at something that's more similar. This is the one that's right down the street. Again, that is nice. These 2 bedrooms are smaller than ours, 820. We're at 950 for 1562. Again, this building is not as nice. The interiors are not even close to as nice as what we've got over here at Royal Oakland and what we're going to do with the renovations. So let's go back. So there's almost 1,600 there. Let's look at Let's look at these. Oh, God. I don't like these. These are old, dated. Got laundry in a unit. They're 2 beds, 1150. So they're bigger, but they're asking 2100. The smaller ones, 1,000 square feet, 2 bed, 1 bath, they're asking 1750. And if you remember on our rent roll, they're saying the market rent's 1700. I'd say they're about right with that. Honestly, it might be able to be a little bit more because they're nicer than these. A little smaller than this 1750, but they're nicer. So based on what my gut's telling me, with the brand new 1 bedrooms at some of these nicer new places are 1900 to 2000. I think for a 2 bedroom, a well-sized 2 bedroom, we could probably get 1750 to 1800 based on what I'm seeing. So I'm going to go in here and put that in here. They got 1600, but I think they're shooting low. They can get higher. So let's go ahead and say 1500 for the 1, 1750 for the 2s. All of them are going to be renovated. We've got 4 that are already renovated, and now we're going to pay to renovate the remaining 16 units. So I'm going to go over to renovations here real quick, and just for the sake of getting these prices in, $0 for these because these are already nicely renovated, and I'm going to go ahead and just put $25,000 for these units because that's what I'm estimating that renovation cost is going to be. Okay, so we're done with this page. We've set on our renovations tab that we're going to renovate all units, or that we want to use the renovated rents for all units. If you set them to renovated, then it's going to use these rents. If you have a mixture, then if you have some in the classic still, like let's say we didn't do any of these, this is how it calculates in the analyzer is we have 3 units at this rate, and we have these units at these rates. So depending on if you put it in classic or renovated on the renovations page, that's what determines which rental rate it's going to use. So we want to use these. These are our new rental rates. So we're going to put everything in the renovated section here. So hopefully that makes sense. You select renovated here. Do not, like I said, don't touch the white cells. Only touch the blue cells. These are for your classic units if you have any, and these are for your renovated units if you have any. So we've set them all to renovated. They're going to use these rents. All right. And then we've got some metrics over here. It just shows us metrics, standard price per square foot, renovated per square foot, all that. And this is actually classic. Standard is actually classic. So, and then down here, you have a comparables table if you want to use this. This doesn't affect your analysis, as it says. It's for your purposes. So I can go in and put those comps in here, and it kicks out a price per square foot to help me estimate maybe what my price per square foot is going to be. It's just a little tool. So next, let's go to inputs. Inputs page. So some of this is already filled out for us based on the rent roll. We have our total number of units. We have 17 currently occupied, and this is the total rent for all occupied units. CapEx reserves per unit. I normally stick with 250. This is something that the lender will normally charge. They have a reserve holdback for CapEx, and that's charged and stored with the lender in escrow. And normally it's around $250 a unit. So that's pretty typical. Property management fee. Normally for something like this, I've talked to management companies in the area that are like 4 to 5%, because it's a higher, it's a low maintenance Class A property. It's not a ton of work to lease it because it's in a nice area. And it's a high income producing. These rents are, in the mid 1,000s. If they were all $800 to $900 for 20 units, they'd probably charge a little higher, 7, 8, 9%. But we've got about a 5% fee here. So that's that. Next section, we're just working our way down on this inputs tab. We're going tab to tab, and we're working our way down on making sure all the inputs and assumptions are met. So next is property taxes. Every state, we could do a separate section just on property taxes. That could be its own video. But property taxes, I'll give you a high level. Every state, and normally it's by state, has a different method of calculating taxes. Sometimes different counties have different methods. But within that state or within that county, you have a certain method of calculating the taxes, and everyone's different. And then within every city, every city or district, right? You have different property tax rates. Sometimes it's by zip code or state, city, but you're gonna have different tax rates. So there's 3 methods I've got here on the analyzer, because those are the 3 main methods that we are gonna use. We have a percent rate, a millage rate, or you just select O for manual override. And if you do manual override, it's going to fill in the tax amount here. So let's say I put 25,000. It's going to, on the pro forma, scroll down, it's going to put in that manual amount here. So what we're doing, and I don't know if I mentioned this before, guys, but by uploading and parsing that T12 here, right here, it automatically pulled over. I don't think I showed you this yet, but it automatically pulled over all this data into the T12 row. So we've got on our pro forma here, as you guys can see, it's a year-by-year projection up to 10 years, right? It's a year-by-year projection of what our income and expenses are going to be. And I've got a T12 column here because I want to see what did the past 12 months look like compared to what is my first 12 months or first year in ownership going to look like. So we've got these here, and then we could look at side by side what each of these categories like. So their current property taxes per the T12, 26,000. We're going to go ahead and go back here. I just want to show you what that looked like because this is where you fill out the taxes. In Michigan, they use what's called a millage rate. So if you got to read through each of these. So we've got a property tax method. We're going to set to millage rate. Taxable/assessed value percent of purchase price. I know it's a mouthful. What that means is what percent of the purchase price is the taxable value or the assessed value. Those words are sometimes interchangeable. In Michigan, the way they do it is when you buy a property, it's a disclosure state, so it's recorded. The purchase price that you buy a property for gets recorded. They normally will go in and reassess the property. Obviously there's a couple different values. There's a purchase price of a property. There's the market value, which maybe is a different, what's the actual market value of the property? And maybe it's different than the purchase price. Normally it's the same. And then there's the taxable or assessed value, which is a value that the city or the county sets for a property for tax purposes, taxable value. And so they normally use that taxable value and assign a millage rate or a tax rate to it, and that's how you get your property taxes. So there's a couple factors we got to put in here. What percent of the purchase price is our new assessed value going to be? And if we are looking at on this financing tab, the asking price is $4 million. Oops, I need another zero. We don't know what our purchase price is going to be yet, but basically, going back here to inputs, in Michigan, it's capped at 50%. So in other states, like Texas uses the rate method, right? So normally it's 80 to 90% of the purchase price is the new assessed value. So 85% of $4 million asking price or purchase price would be $3.4 million. And then based on that, they will use a tax rate. 2.67% of the assessed value is the new year one property taxes. So in Michigan, they use the millage rate. It's capped at 50%, the assessed value, and they don't use that, right? Ignore if using millage rate method. Ignore if using percent rate method. So tax millage rate, the millage rates it's basically like a percentage. It's just worded different. They're normally like 60 to 70, 50 to 70. So I think Royal Oak 65. Royal Oak, Michigan millage rates. So I think I can go 2021 millage rates. Type in Royal Oak. Not Royal Oak Township, Royal Oak City. And let's go and look at the legend up here. Non-homestead total millage. School district of Royal Oak, that's what we're in. 55.54. Okay, so we'll go back here. And it's 55.5. You can say 56 to be conservative. So if they assess the maximum is 50%, they could assess it at 40% of the purchase price. It could be 35. They're supposed to use comps in the area based on your purchase price. So if you purchase it for $4 million, right, they want to use other comps in the area to support the millage rate. They can't just, in Michigan, just based on my knowledge of how Michigan works, they're technically not allowed to use your exact purchase price to set the new assessed value. They're supposed to use other comps in the area or an income approach, actually using the income of the property. So a lot of times they'll assess it high, and then you can go in and fight them on it and get it reduced. But let's say worst freaking case. Buy it for $4 million. they assess it at $2 million, 50%, and they use the millage rate, which is basically divide 2 million by 1,000, multiply by 56, or essentially a 5.6% tax rate on this, right? It'd almost be the same as doing this, 50, and using a 5.6% tax rate. It's the same thing. It's just they call it a millage rate, and it's annoying, but it's the same thing. So we'll set that. Based on my knowledge of Michigan, I would say that they'll probably assess it in the 40% range because depending on how many comps are in the area, 40, 45. So we could say 45. I normally, would like to coach you guys on this as go to the worst case scenario to start, because it is very possible that they could take it to the worst case scenario, in which case your taxes are going to be, $112,000 a year. Knowing Michigan, I'm going to set it to 45. But if you're trying to, in a new area, you don't know, be a little conservative. It's always better to be safe than sorry. Just go with the full amount. So these are our projected potential taxes, which is really high. So I think it's unlikely for that to happen, but we shall see, right? And this will change if we don't actually make an offer at $4 million. Let's say we offer at $3 million, because this all flows well, right? Now it's basing this 45% on $3 million, and it's going to be lower. And it all flows, and this whole analyzer is linked perfectly, because obviously if you're going to offer something lower, you can't base your tax on a higher offer. You want it to be based on what price you're actually offering and going to buy it at. So it all links. So we'll leave it there for now. Or I'll bring it back to $4 million, because I always like starting the analysis at their asking price and then backing the price down from there. I start at their asking price. I see how crazy they are. If they're out of this world crazy, then, I'm going to go ahead and just back the price down. So let's continue moving down. Growth rates is the next section. And this is essentially just saying at what rate is our utility income going to grow, our other income going to grow, all expenses, insurance, payroll, repairs and maintenance, taxes. This is all preset when you open up the analyzer. I normally just keep it at these presets. I find that those work pretty well for most markets, but you could obviously adjust anything that you would like. Closing and transaction costs. These are the costs you're going to incur along your due diligence period, your closing period, up until the point of purchase. And there's always costs that we're going to incur. There's some that are optional. Construction management fee. This is something that is a percent of the renovation cost of the project that you're going to charge as the owner or the syndicator or the sponsor. I normally don't charge one, but it's in there if you need it. Financing fee. I use brokers a lot or banks, and they'll charge normally 1% of the loan amount. So I leave that in there. Appraisal, $5,000 is pretty common. Survey and environmental, that's pretty typical for costs that we're going to see there. Actually, nowadays it's a little higher, so I'll bump that up. 1 year insurance escrow, that's pretty typical. Once we set what our insurance cost is going to be going forward, so let's say based on their $13,000, let's just say we're going to be at $13,000. It's going to go ahead and here, and we selected yes, so it's going to $13,000. Because a lot of banks will require that when you purchase a property that you've got to pay a year up front, so that if you stop paying your payment, you're always covered for next year. It's an escrow that they require. And so not every bank requires it, but I always like to be conservative. Hey, if I don't need it, I've got another $13,000 at closing that I get back or that I don't have to spend. 2-month tax escrow, again, pretty typical of banks require a 2-month tax escrow. I just always keep it in there. I think it's just a nice additional buffer. I've got all these little levers in the analyzer that make it more conservative. In Michigan, proration of taxes, every state's different. Some states' taxes are paid in advance. Some states' taxes are paid in arrears. If you pay in advance, for example, in 2022, I would pay my taxes in January, which would pay for all of January taxes. Normally you pay twice a year, but this is just an example. If I pay them in advance, I pay them in January, or the seller pays them in January, I'm going to come buy a property in June. The seller's already paid for January through December, the whole year. I buy it in June. I've got to pay the seller back for July through December that he's already paid for. And so in that case, which is how Michigan does it, I got to pay for 50% proration of those annual taxes back to the seller. And it's using 50% of the current property taxes. In Texas, for example, taxes are paid in arrears, meaning that if I buy the property in June, the seller is not going to pay 2022 taxes till December, just as an example again. So if he's waiting to pay the $25,000 in taxes till December, but he's owned it for January through June, I'm buying it in June, he's got to pay me because now I'm going to have to pay the full $25,000 tax bill when December comes, but I didn't own the property for the full 12 months. I've only owned it for the second half of the year. So he's actually at closing going to pay me. So technically it would be something like that, -50. It's going to credit me some closing costs. Again, I'm conservative. I normally just leave it at 0 when I'm buying a property in Texas. And then, yes, I get a credit at closing, which is nice. It pays for some of my other closing costs, but I'm always conservative. I'd rather just leave it at 0. Title policy, this is just an estimation, 0.25%. That's typically what I see on closings. Buyer attorney legal fees, different for every deal. Sometimes you spend less, sometimes you spend more. I think $10K is pretty reasonable. Lender legal is, again, something you're going to pay for the lender's costs during the closing transaction process. A lot of times it's less than this, but I like to leave it there. Loan costs, this can sometimes be more, $5,000 to $10,000. If you have any repair escrows, so if the lender is going to require you to hold back, let's say $25,000 for certain renovations, I normally will throw that in there. And then we've got some miscellaneous stuff like if you're going to pay an underwriting fee, other fees, miscellaneous. So normally I'll go in and I'll throw $15,000 to $25,000 in miscellaneous, depending on the size of the deal, to cover any other potential overages, right? And so, you can just see we're a little conservative. All of these inputs here are flowing through to this income and expense tab. We've got some analytics here on current and market, what the rent potentials are, and then out-of-pocket costs. That's where those flow over to. Obviously, we've got some of our renovation dollars, but then we've got all of the other out-of-pocket costs and transaction costs that we just put in here, closing and transaction, right here, and it totals them up. So basically, everything besides our down payment totals here. So besides, yes, we're going to make a down payment on the property, but here is the rest of our closing or out-of-pocket costs on this project is paid right here. So we've got all that in there. So final section here, syndication and investment returns, or investment structure. That's what we like to call it. We've got some options here. So we're going to go through syndications a little bit more in other chapters, and we've already touched on it a little bit. You guys may already understand how it works, but this is where you set the structure of the investment. And this flows over, it's purple because it flows over to this purple tab, investment returns, investor returns. So in this section, we're taking the net income of the property and the profits when you sell a property, and we're flowing it into this model, which distributes out the cash flow based on the structure that you set for the investors. So is there a preferred return? What's the split? And the split is between the investors, we got a sample investment here, and the manager, right? So the manager, you, the sponsor, you're going to have certain returns in this property based on what the split's going to be. So, for example, I'll just show you really quick because we're going to go and do specific video on structures after. Let's set it to 50-50. That means that the investor now gets 50% split on all cash flow and a 50% split on all profits when it's sold. The sponsor gets a 50% split on income and profits when it's sold. For the purposes of analyzing this deal, just to show you guys the first time, I'm going to set this, when you're buying a property on your own, for example, I'm not using any investors, you just set all that to 100. And that means you're going to be 100% owner, there's only one buyer, and all the capital that's put out, you're going to get the returns back on it to yourself. Investor return threshold, that basically just highlights this row right here, red or green. It's actually not showing up right now. But typically what it'll do is it'll show this row in red or green based on if it's under or over that threshold. And asset management fee, I'll go back to here first. Owner/GP managed, yes or no. If it's yes, what it's going to do is it's going to take the property management fee and it's going to put it down to this manager total returns. And if it's no, it's not going to put it there. Basically, it's saying is the GP managing the property. Asset management fee, that is going to also show up in here, our asset management fee, and that's also going to take out of our net income over here, asset management fee, and basically that is a percentage of the gross income that's going to be paid to the sponsor, And then finally, acquisition fee. Are you going to charge an acquisition fee on the deal for putting it together or syndicating it? It's very typical to charge an acquisition fee of a couple percent. So this is the syndication investment returns section. We'll go over that more in depth later on. I'm going to set it now and look at this deal as if we're buying it as a sole owner, sole investor. Okay, so that tab's done. We're done there. Pro forma. Now we're going to go and we're going to project a couple things. One is going to be what are our vacancies and occupancies? What are our rent growths? And what are our other income? Make sure we line our incomes up, projections. And then what are our expenses? Right? We're going to look at our expenses. What are those going to be? And then we're going to look at our NOI and see, hey, are we growing our net operating income? What does this look like? And then we're going to go from there. So let's go and take a look here. Back to the pro forma. First, this is part of the reason why we have the T12 numbers brought in, because I want to look T12 to year one going forward. First, see what this looks like. So right now they're not charging. Let me see the utility reimbursement. Utility billing income, water, sewer, gas income. So they're actually charging a little bit. Maybe it wasn't fully categorized when we parse this analyzer, but we've got about 6,700. So I'm actually going to go put 6,700 in here, and I'm going to take it out of here because it was grouped in with this other income. So 6,700, we've got about another 1,700 in other income here. So I think just because those weren't properly categorized, we're going to just readjust those so our projections are correct here. But I think we'll probably increase our other income a little bit after we buy the property. It's pretty typical. 3,000 divided by 20 units, $150. That's pretty common. $150 a unit a year for other income. So let's go and look at our income now. The next thing I do is I look at income. I look at what did they collect over the last 12 months. What are we saying we're going to collect over the next 12 months? One thing to note is when you look at a T12, look at the most recent, like 3 months, for example. These average about 26,866. So let's say 27,000 is the average times 12, 324. So obviously, as we can see, because it's a growing income property, we're buying a property that has, income that started at 20,000 and now it's up to 27,000. We want to make sure, we're not really going to estimate our income based on the last 12 months. We're going to have some growth. Obviously, we're going to renovate units. We're bumping rents. So we're going to see this grow a lot more over the next couple of years. But year one, right, you're never going to see your full rent bumps realized in year one. And so I kind of throttle this to grow gradually over a couple of years. So, but if we see 27,000 in the last couple of months, 324,000, that means that this 329 is like very reasonable. Honestly, we probably get even a little bit better there. So 332, vacancy 5%. Let's go ahead and do this because I feel really good we're going to hit these rents. I normally start by looking at this, like I said, looking at the last 12-month income. What's our first 12-month income? And then what's year two? Are we seeing some gradual growth? If you have like a huge renovation program like here, we're going to bump these rents quite a bit. We want to see, obviously, a lot of income growth. And so, we need to make sure that we're reducing our loss to lease, vacancy loss, concessions, all that kind of things. So loss to lease is there right now. There's a lot of loss to lease because the rents are far below market value. As we bump rents to market value, the loss to lease goes down. Loss to lease essentially is what am I losing by charging less than what the market rent is? And every dollar that you're charging below market rent totals up into this loss to lease column. And they show the market potential up here. And then they take out, hey, this is the difference between the $1,400 we're supposed to be charging and the $1,100 you're actually charging. So that $300 a month goes into this category, add up all the units together, and that's what loss to lease is. So gross operating income, I feel pretty good about this. This is a pretty good, it takes some intuition. Yes, you can go and literally calculate every unit, project when you're going to renovate every unit. Like, hey, in month 3, I'm going to renovate this unit. Month 4, I'm going to renovate these 2, 5. And you can put it together in this complex spreadsheet. I mean, I bet at the end of the day, you're going to come out with pretty similar to just eyeballing this based on your intuition and what we think our year 1, 2, and 3 increases are going to be. Normally, if you're doing a value add, you're going to see maybe a 5 to 10% increase in income in year 1. Year 2, another 10 to 20% because we're bumping rents quite a bit. And then year 3, it kind of stabilizes out, another 3 to 5% after that. So year 2 is where we see the biggest jump from 1 to 2 because, we've had a full 12 months to renovate a bunch of units. And now we have our second full set of 12 months with renovated rents. Year 1, you're going to have higher vacancy, maybe higher rents that you're increasing, but higher vacancy because of the turnover, the renovations. So we just want to make sure we're being conservative here. And I feel pretty good about this increase in income over the 5 years. We're going to go ahead and set the rent growth. In this area, we're seeing higher rent growth. So I'm going to go ahead and set 2.5 all the way up to 3 in year 5. I feel comfortable with that. So next, what's really cool about lining up the T12 and a year 1 side by side is as long as we think they're managing it fairly well, we can use these as a baseline for a lot of our expenses. It's not going to be perfect. We have our own rules we're going to look at in terms of going in and I'm going to change this format. In terms of going in and that was not the right format that I want. We're going to copy this cell. In terms of going in and, estimating what we want going forward, they're not always going to be fully accurate. So we have to use these, I put some guides in here. We'll use these guides, some intuition as well, and make sure we're estimating and projecting the right amounts. And then we have some safeguards we could check at the end and make sure, hey, we're on track. So advertising, I think for a 20-unit building, it's pretty safe to say that this 4,500 is pretty accurate. That puts us at $225 a unit. We're well over what I'm seeing the average is. So honestly, we might even be able to drop that down, $3,000. Contract services, $15, $725 a unit. We're seeing $200 to $400 annually. These guys are probably overspending. We can check by going and looking in contract services, seeing what they're spending money on. Snow removal, other building services, $2,000. Common area cleaning. So, wow, these guys are spending a lot on cleaning. Maybe it's a necessary thing. Maybe the cleaning is really important here, and it's necessary to keep the property clean because we're in a Class A area. They want to really make sure it's in nice shape. More important than like a Class C or D building. So, and they got snow. These all seem kind of reasonable. So, I don't know. Maybe there's a way to get those cleaning fees down. Contract services, as I was talking about, we've got about $15,000 here. I would say let's keep it at $14,000 for now. Maybe we could bump it down to $12,000. With the cleaning costs, we could save a little bit. General administrative, there's not a lot of that type of stuff here. It's management company costs that are probably going to be charged back. So I think we could stick with the same. Payroll seems pretty high, but let's go ahead and let's look here and see what we're seeing on the payroll side of things. Payroll up here, $2,000 a month, $2,800 payroll allocation. So when I go through this T12, oftentimes I'll mark out certain things, and then go ask a question to the seller, like, "Hey, why is this item stand out?" So it seems like there was a one large item here. I don't know what that is. Office wages. Why was that higher? And then I'll run this by my new management company and say, "Hey, what do you guys think? Is this high, low? What do you guys think this is going to be?" Management fees, that's obviously reasonable. $10,000. It's about 4 or 5%. So payroll, I think we're going to be lower than that. $25,000. That puts us at around $1,250 a unit, which is pretty common here, right around that $1,000, $1,200 per unit mark. Repairs and maintenance, normally we're about $400 a unit. It's a really clean property, so maybe that's why it's less. There's not a lot of repairs because we're doing all the renovations. Turnover, they don't have any turnover. We do. I normally put $250 a unit for turnover. And the cool thing, this is where you can actually edit this analyzer if you want to, and I'll show you another point here in the taxes that we're going to do. But you can edit this. Let's say, for example, you plan to go in and renovate every unit when it turns. Well, if you're going to do that in the first year or two, you're not going to have any turnover costs out of your income because you're going to budget that ahead of time and have reserves to do those renovations. So maybe in year 1 we don't have any, but year 2 going forward, we have it. So in that case, you can go and you're allowed to break the rule. You can go and put something in the white cell here and edit it. You don't have to be an Excel guru to do that, but you can manually enter stuff in here if you want. Utilities, I almost always just base it off of what they have because utilities, it's not under your control really. It kind of is what it is. So whatever they have, I'll go up 5% or something like that. Make sure I'm being conservative there. I will, however, if I see it at an absurd rate, I will sometimes go in. Let's go look at utilities. If I see some of these utilities at absurd costs, like for example, water and sewer, in most properties that is on a master meter, so the landlord pays it. Whether we're getting reimbursed or not, the landlord pays it. If I see that is over like $700 a unit, let's do this. So it's 400 a unit. So that's in a really good shape. That's not too high. If I see it's over $700-800 a unit, maybe there's a lot of leaks at the property. Maybe the tenants are abusing the water situation and we need to put a stricter policy in place. Like, hey, you guys are now paying for water, and hopefully that kind of gets it under control. Common area gas, is there a way to maybe these are separately metered and I'm paying it as the landlord, but I could have the tenants start paying this. That saves me $10,000 a year. All these things are ways that we can improve our expenses and reduce our expenses. So maybe with that said, we want to start collecting some of those gas costs back. Maybe I'm going to bump this up to $12,000. I'm going to start trying to collect more on my utilities. That's part of my plan. Everything plays into the plan and all these numbers flow together. And at the end, you're going to see how cool this is, how this all adds up and just shows us, hey, this is what our returns are going to be at the end of the day. So utilities, insurance, 648, 650. It seems a little high. I'm going to go ahead and put 11,000 because, based on my knowledge, we're around the 550 for a building this size on the insurance per unit per year. 550 right there. That's what I think. So here's one interesting thing. We're at the $4 million asking price, right? Which is really high, $200,000 a unit. But this is a really nice property in a really nice area. So when I look at these taxes and see $5,000 per unit per year, that's absurdly high. Very uncommon. And that's if we bought this property at $4 million, right? Which is unlikely based on what we're seeing. The taxes would go up 4 times what they're at. Now, the first thing to take into consideration is, we're being conservative by saying year 1 it's going to happen. Normally it takes another year for the actual assessment to take place. So maybe this would start year 2. But I also, just looking at this, don't think it's reasonable that they're going to charge this much in taxes, $5,000 a unit. Remember what I told you about they max assess it at 50%? Well, unless there's comps to support it, other than your property, they normally will assess it lower, or you can go and fight it and get them to assess it lower. So in this case, I'm thinking, that's a really high assessment value, and it's unlikely that they're going to do that in the first year to me. So, and again, this is based on knowledge of the area. You've got to call the local assessor's office if you want some more insight and info. I've bought a lot of properties in these areas, so I just know what's likely and what's not. However, again, like what I said, you could be really conservative and just estimate worst case. But, in this case, I think it's unlikely we're going to quadruple our taxes in year 1. I could always bring this over here and say, hey, going forward, or year 1, I think maybe we're going to be more like 40,000. And then at year 2, that assessment's going to take place. So you can make these adjustments in the analyzer like I just did there. If you know how to use Excel, it's not too difficult. You just kind of cut this cell, Command X or Control X, and you paste it here. You got to make sure the equation flows through, that this cell equals this, right? And then it all flows with the proper increases based on our 3% annual increase. So 40,000, I think this is probably what's going to happen. And this still we might not even get assessed this high. But it's possible. So when we say it's possible, we like to be conservative because if it happens, I want to have known about it and budgeted about it up front and not be too surprised. So the interesting thing you're going to see right? Because as you guys know, we talked about net operating income, cap rates, and whatnot. We want to see NOI growth. So I want to see that in year 5, my NOI is substantially higher than where it was. The crappy part about when you're in states that bump the taxes up right away, there's other states like, if you're in Nevada, they don't charge a lot of property taxes, and they normally don't bump you a ton. There's like caps on how much they can increase, right? Most states have a cap, but a lot of states say when the property sells, it becomes uncapped and they can reassess it at whatever they want. So right away, when you buy a property, this is why we have to value add properties. We have to increase the income. You have to. Because right away, when you buy a property for more than what it sold for in the past, your taxes are going to go up. Your operating expenses a lot of times are going to go up if they're mismanaging it or undermanaging it. And right away, yes, year 1 we're good, but when this tax bump hits, we're going back down another $50,000. Our NOI is going right back to where it started. And that's not value add. Value add is buying a property, increasing the NOI, which in turn increases the value of the property. So, with that said, we have to plan on increasing the income. We're increasing the income almost $100K over 5 years, which really, it just mitigates some of our increases in expenses. We're not increasing it. So what that means is we have to buy this property for less. We can't buy it at a 4 cap and in 5 years be at a 4 cap still. So we have to buy it for less, which means we're going to have less of a tax increase. We're going to have less of or higher cap rate on the exit and all that, right? Our operating expenses are 55%. They should be lower than that, right? So we're looking at a couple things that maybe, we're a little high on our expenses here because of these taxes. So we really need to mitigate some of that. And I think part of that comes into play where we've got a little high expenses here. Our payroll, for example, maybe is a little high. I would run this by your management company. Run these numbers by a management company and say, hey, what do you think of these numbers? Are we high? Are we low? What are you thinking? So I still think this is high and unlikely to happen. But if it does, we're prepared for it. So I think we look good here. We can see based on what the initial financing purchase price is set, we've got some cash flow, but then we're running into some cash flow issues when interest-only period ends after 3 years. So we'll get into that in a minute. Renovations, $25,000 a unit with our rent bumps. And we're going to go ahead and we don't know exactly what we need to do at the property, but normally in renovations, I'll back up a step. There's no inputs on this page. So this is just for analytics purposes. But go to the renovations tab. There's a lot of sections where you can put in, hey, do we need to replace the roof, siding, asphalt, bunch of general stuff. Obviously the unit renovation section, which I've showed you guys, how much are we spending per unit and what are our bumps? And then, what are the rest of our renovation costs? Some of these pull in automatically, and then some of these are custom categories that you can make. So I always just start by throwing in a contingency. This property's in really good shape already. We don't need a roof. It's a brand new roof. We don't need new parking lot. We don't need much. So I'm just going to go ahead and put like $25,000 in. Well, there might be some cleanup, some trees that we need to trim, some landscaping we want to do, but the property does not need much overall. You might want to paint some stuff, but it's in good shape. So I'll normally just throw a number into contingency, depending on how bad the property is. If this property was rough, I might throw like $100,000 or $150,000, and then we'll come back to kind of divvying that out into specific categories once we do a walkthrough and actually do our due diligence. So next, sources and uses. Based on the purchase price that's set in there is $4 million. This is where we're at. There's no inputs here. This page just breaks down again. What's our loan proceeds? How much capital do we need? What's the total project cost? And then it breaks down, purchase price, renovations, closing costs, all that kind of stuff. So no inputs needed here. Financing details. This page is really important. This page is where we determine the purchase price. What's our loan amount? Interest rate, interest only, amortization. Are we going to refinance the property? And when are we going to sell it? And what's the exit cap rate? So one thing to note, or a couple things to note. Look at this first. Sales price exceeds total project cost. If it says no, it's no deal. What this means is, what is our total project cost? Okay, we're going to be all in. If we buy it for $4 million, we have $543,000 in out-of-pocket costs, which you guys saw. $425 in renovations. The rest of these are closing costs. $543. So that's how we get our total project cost. It's the purchase price plus everything else. $4,543,000. What this is saying here, sale price exceeds total project cost. No. That means with what we're saying is a sale at year 5. How this calculates is we set the year, we set a sale cap rate, the exit cap rate. So at year 5, it takes the NOI, year 5 NOI, 179. At a 6% cap rate, this is it tries to determine the sales price of the property. So this is the funny thing. If the sale price at that cap rate at that year does not exceed the total project cost, it says no, and it just auto sets the sale market value to what your project cost is by default. So actually 179 divided by a 6 cap is 2.9. So we're way off. This is actually an improper cap rate. This area is more like a 5% cap rate area. But even at a 5 cap, let's see if it updates there. Even at a 5 cap, we're not exceeding that price. So what that means is we're paying too much for the property. So let's go and just back this down. This is how I normally do it. I will go in and I'll set my exit cap rate. I'm going to go with 5.25 to be a little bit more conservative. I set my exit cap rate. I set my 75% loan to value. I'm actually going to do a bridge loan, which a bridge loan wraps in all of our out-of-pocket costs and it reduces our down payment. So you can see we have 1.5 we need to bring. If we do a bridge loan, we actually don't need to bring as much capital. We get a bigger loan, and we'll get some interest only. But then we're going to have to refi in about 3 years, right? So let's go ahead and say in 3 years, we've got to refi the property, 75% loan to value. I've got to make sure I could take out this original loan, which it's not looking like we can do. So I'm going to leave that off for now. Let's say we're going to do a bridge loan. Let's say we're going to do a normal loan. Let's just look at it standard to start. Doing a normal loan. At $4 million, this deal's not working. We're not selling it for more. If we go to our returns, we go ahead and hide all this for now. Give us a little bit more space to view what we want to view. All right, let's hide those rows. So we're looking at our investors' returns. Hide this as well. Okay. So our total, a 5-year IRR is not even there. We're not even cash flowing year 4 and 5. And the reason that shows that is because we have a 3-year interest only period on the loan. We could set that to 0 and watch. It's not going to cash flow at all. Cash flows a little bit in the first year, but then our taxes go up, so then we stop cash flowing. So we're obviously paying too much. So I'm going to drop this price down to $3.5 million. We're still not exceeding. Let's go down to $3 million. All right, now we're in good shape. So we're planning to sell it for $200 a unit, 3.8 at a 5.25 cap in 5 years. Our all-in project cost is 3.5. So it's still not great. Let's see what that looks like return-wise. 9.33. Yeah, so we're not in great shape there. The only things that could change this, again, we keep dropping the purchase price. Right? Now we're in better shape. We drop the purchase price. Let's look at what our taxes are. See, now our taxes are $62,000. So because the purchase price is way lower, our taxes are way lower. We're a better expense ratio. We've got more NOI growth, really solid NOI growth. The only other thing we could do is say, hey, let's hold it for longer. Let's say we hold it for 7 years. Income keeps increasing. Sale price keeps increasing. All right. And we're not doing a bridge loan here. Investment returns. Still not looking that great. So what we've got to do in this scenario, one or two things. One, depending on where our rents are at, right, that can improve the scenario. So if we think we can actually get higher rents, which I think we can, but I want to be conservative, so I'm not going to change these. But you can go back and adjust those. You could look at your pro forma. Make sure, like I said, run it by your management company. Maybe our operating expenses are higher. But if everything is set in stone, right, all of our assumptions are set, the only factor that can reduce or increase returns at this point is our purchase price. So if we're looking at a standard 5-year sale, we're going to have to get our price down here. All right, now we're hitting good returns. I'm looking for a 15 IRR, a 2 equity multiple, and close to an 8% cash on cash in 5 years. So what's the highest number I can get to that allows me to do that? 17, we're getting pretty close. 2.7. So at 2.7 million, it looks like we're right there. We're close to a 15, 2 equity multiple, and we've got 6% cash on cash, which is fine because we're hitting these other 2 numbers. I'm looking for 2 out of 3 of these. Total return, 100%, which would be a 2 equity multiple. So that's what I'm doing, guys. We're going through, we're filling everything out, which is just data collection. Oops, I'm dragging that cell. It's just data collection and assumptions using resources, your management company, whatever it is, touring the site to get your renovation costs. And then after that, we're literally just taking their asking price and reducing that purchase price until we get to the returns that we want to see. I have certain return thresholds I want to see, and all I do is I take the asking price, I reduce it. In this case, if they're asking $4 million and we're coming down to 2.7, it's unlikely they're going to take that offer, but that is what works for us. And that's how we do this in multifamily real estate, is we put offers in at prices that make sense for us, not anyone else, not the seller. They could ask 10 million, right? But 2.7 is how we're going to buy it and make money based on all of these conservative factors, our underwriting. This spreadsheet is designed to give you guys that answer, and it makes it easy. You just go and input a bunch of stuff, a bunch of numbers and assumptions, and then you change the purchase price until you get to returns that make sense. And the reason that the purchase price is what affects this return is the down payment is dictated by the purchase price, and your loan amount is dictated by the purchase price. The lower the loan amount, the lower your down payment, right? We're at 1.2 now, where we were at 1.5 before, right? 4 million, 1.5. The higher your down payment, the lower your return on investment. And same with the loan. The higher your loan amount, if you're buying it for more, the higher your loan amount, the higher your payment is going to be. And the higher the payment, the lower the cash on cash return, and the lower your cash flow is. So in real estate, when you buy right, you make money, is the age-old saying. And so we're focused on paying the right price for a property in order to get specific certain returns on investment. I've used this analyzer to buy over $100 million in multifamily property. I've always hit my projections because of it. It's conservative. It's easy to use. It works. It takes the guesswork out of everything for you guys. And if you like the analysis, I think it's fun, right? You throw everything in there, and then it spits out different answers, and you have to use your intuition to kind of, make guesses and assumptions on what's the right way to play this thing. So at the end of the day, what I would say is for this property, I would offer 2.7 in its current state. If things change and we can get rents higher, we might be able to pay more, get close to their asking price. If our management company says, hey, your payroll's really only going to be $15,000, and I think we can cut our contract services down to 10. Your rent's actually $1,550, and we think we can get $1,800 for these. Maybe that happens. And now we're in good shape. Our NOI is higher. Our returns are a lot higher. Maybe now we can pay 2.9. Right? Maybe we could pay $3 million and get those same returns. So thank you for watching. I hope that was helpful. Go find some deals. Go talk to brokers. Go call some sellers. Get some rent rolls and T12s in. Get in the software. Play around with it. Start analyzing deals. It took me about 10 to 20 of these to really start getting a hold of it and making it easy, seeing how everything in the analyzer flows. But you want to use the same spreadsheet over and over again, because then you can see how certain inputs affect certain outputs. And so I suggest you use our software and this analyzer to do your analysis. It makes everything easy, and you can get in there and look at all your properties that you're looking at, and organized. You can make offers right from there. And so that is how you underwrite a property, guys. I hope you enjoyed, and I will catch you on the next video.